Okay, this picks up where the last video left off. So we're talking about our elements in our conceptual framework. So the elements of the financial statements, these again are going to go into all of the details that we'll eventually get into when we have our actual financial statements. So in the top three, assets, liability, and equity, those are all part of our balance sheet. Our statement of retained earnings shows investments by the owners, distributions to the owners, any comprehensive income. And then our income statement has our revenues less our expenses, any gains and any losses. So these are all different components within those different financial statements. And the underlying assumption is that there's the one economic entity. So as you get into advanced accounting topics later, there'll be consolidations where we're bringing in multiple companies, but still they're housed under one economic entity. So there's specifically, what happened to that particular corporate agency. The going concern insinuates that the company or the corporation is going to continue on into the future. We have no reason to believe that it's going under and it's going out of business. Periodicity assumption is that we were breaking into different we're breaking our time periods into different levels. So we say we make monthly financial statements, we make quarterly financial statements, we make annual. So we don't continue on and on forever. We break it into these different periods, and then that is what we show in our financial statements. And then for the United States, our monetary unit is going to be the US dollar. Okay, then we get into our recognition and measurement. So recognition is that we are saying, yes, whatever information we're talking about needs to go into our financial statements. Measurement is that there's a dollar amount that we can actually associate with it. And then disclosure is either we're going to put it into those financial statements, like the balance sheet, the income statement, or like I said, like say it's a lawsuit that we know is happening, but we don't have a specific amount yet, then we may just disclose it in the notes to the financial statements so that everybody knows about it. But again, we don't actually put it into our balance sheet as a liability yet because we don't have that exact amount. So revenue recognition, when we have provided either a product or a service to a customer, so we've already done it and we know the dollar amount. So when the earnings process is complete and we know that we have a certain dollar amount that we will collect, we can record that revenue. So it doesn't have to follow cash. It can follow cash, but it doesn't have to follow cash. As long as we know the dollar amount and it's been performed. And expenses, we have some different approaches. So we can say a cause versus effect. So like if we are going to tie it specifically to a revenue that we have recorded already, and we know there's expenses associated with that revenue, we would want to record those, again, whether we've paid for them or not. If we have a systematic way to allocate those out to specific time periods. So say we pay our insurance for the whole year, at the end of every month, we're going to charge that off to insurance expense, just that 1 month portion of it. Or then it could just be in the period that it's incurred. So we have an electric bill and we've paid it. We've got rent and we've paid it. We've got services revenue or services charges that we're going to pay. Okay, then we have a measurement model. So we always record our transactions at historical cost. If we have investments that maybe change in value, we may record those at their net realizable value. So think about like say it's a accounts receivable. So we've billed it out, but we estimate that some of them will be uncollectible. People will not pay us. We're going to record that accounts receivable at its net realizable value, what we actually think we're going to collect back. Our current cost, what would be incurred to purchase or reproduce that asset, a present value if we're talking about something that has the time value of money computations included in there, or the fair value if it's like an investment, something that's bought and sold in the open market. So historical cost, again, is our original transaction value, what we paid for the asset, what we owe on our liabilities, and then again, for our fixed assets, it would be after we've accounted for depreciation. And then here's that net realizable value. Again, like I was talking about, it could be less predictable costs. So, here they're giving us an example of a selling price less the costs to complete it or transport it. If it's the amount of cash that we would get off of an accounts receivable or something like that, we would take that down to our net realizable value after accounting for bad debt. The current cost is the cost to reproduce it if we needed to. And again, that present value is if there's some sort of a time value of money computation in there. Then fair value, again, we'll have different approaches depending on what it is. So say we have a stock portfolio. Depending on what our motives are for having that stock, we can use different approaches. So the market approach is that we're going to value it at whatever the current market value is. So then we can have like unrealized gains or losses. The cost approach would be that it's just going to be the cost required, again, if it was a similar to replace it, a similar type of replacement asset. Okay. And then our fair value option, so that's kind of more what I was talking about with the investments. That again, to say if we were going to record it at their financial assets, so like stocks and bonds and hedges, so we always want to record those at fair value. So again, because those prices in the stock market go up and down, if we're in hedging market, that's like say we do a lot of international business and we want to hedge the change in the US dollar to the euro. We'll enter into some of these complex different hedging transactions, and we'll have receivables or liabilities depending on where that US dollar goes. So those all kind of fall into that category. And then full disclosure, we always want to disclose everything that could be relevant to the investor or to the stockholder. So we can put stuff into the financial statements. We can put those into our notes. Or any supplemental schedules and tables. So here again gives you a nice little summary table of those things. And then that is it for chapter 1.